Hello, this is Brian Rezny, president of Rezny Wealth Management and host of the Rezny Wealth Report. We have an excellent show for you today as always, and if you have questions about your retirement, your portfolio, maybe you have concerns about the advice you're receiving, make sure you send those to Brian Rezny at ReznyWealth.com. You know, it's an interesting year, 2024. Of course, it's an election year. The election's officially over. We do have a new president, which I congratulate President Trump and his new staff that is coming in. One thing I want to stress is I see another 3 to 5 years now of a potential really good economy in the U.S. under this new leadership. Policies do matter. So whether your candidate got elected or not, President Trump is the new president, and his policies before were excellent, and I think his policies are going to be that much better this time around. I think more ultimately will get done. So now is the time for these portfolio changes for 2025. You as an investor have to realize whether you self-manage your money or you're working with a real money management firm like a Rezny Wealth Management. Again, we're a money manager. We don't sell third-party money manager product. We don't sell annuities. We're not a brokerage firm. We're not Wall Street or a bank. We actually manage money, and we do that on a fee-only basis. We've already made adjustments to our clients' portfolios months ago. We already looked at President Trump winning. We felt firmly that President Trump would win this re-election bid. We've already made appropriate changes, what we feel, for our clients and all of our portfolios across the board. Some of you that are listening to my show, your advisor, maybe yourself, is kind of late to the party. You can still make these changes, and you should. Your portfolio should never be static. So what I want to stress is this. One of the things I talked about in the first Trump presidency is we did not own any oil at all because oil was cheap and oil companies, service companies were not making lots of money. Then Biden came in and had a war on fossil fuels, so then we bought oil back 3.5, 4 years ago. We have now sold all that oil exposure, so we are out of oil completely as a sector bet. And it was good, generally speaking, across the board. But now we have President Trump coming back, and we're looking for energy independence again. So we feel that the profitability of energy companies or oil companies are not going to be like they were the last 3.5 or 4 years. So again, we sold it. That's called timely portfolio changes. That's called policy changes. Again, one president has one group of policies, another has a different one. President Trump's coming back. You need to look at your portfolio and decide where is the next 3 to 5 years headed potentially, and what things should you not own and what things should you own. Another great year for the market, by the way, was 2024, but you missed out. We actually had a lot of new clients hire my firm in 2024. Hopefully, if you have not hired us yet, you're going to be calling the office after this show and making an appointment to hire Rezny Wealth Management. But it was another great year, generally speaking, for our clients and for most investors if you were properly invested. If you missed out again, so let me give you an example. The market, the S&P is up over 20% year to date for 2024. That would be typically a growth investor should have had similar type returns. If your portfolio is more growth oriented and you made 6, 7, 8%, that's a problem. I will tell you that I talk to a lot of investors on my TV and radio shows, and they often miss out. I will hear things like, well, the market was up 15%, and I'm a growth portfolio with XYZ company, but I only made 8%. And why is that? Because maybe your portfolio wasn't properly managed. Maybe they have it asset allocated into too many bonds, so you missed out on true growth. Again, don't miss out on future opportunities. Make those important changes in your portfolio when necessary. And if you cannot do that yourself or your current advisor is not doing it properly, maybe you should seek out another firm. International investing is still to be avoided. Let's talk about that. For probably at least 10 or 15 years, we have not owned international investments at Rezny Wealth Management. Pure play international investments we have not owned. And why is that? Because if you look at a lot of countries outside the U.S., they're more socialist, even more regulated than us, and a lot of their companies haven't done that well. So if you look at the returns, let's say for Europe versus the U.S. has done exceptionally well, where Europe has been lackluster at best, or mediocre, maybe is a better way to put it. So often what I see when we have a new client that hires Rezny Wealth Management, they're coming from these smaller, big brokerage firms, banks, or insurance companies. And most of those firms, what we find, practice what's called asset allocation. They spread your money in that pie chart all over the place, and you always have a helping of international, even though it's not appropriate. You actually may have heard comments like, well, we want to diversify your portfolio. Folks, I'm here to tell you, you can diversify your portfolio within the U.S. and get all the diversification you need. You do not have to invest overseas or emerging markets if you don't want to and don't need to, or maybe should not, based upon the growth of those countries specific. You need to understand, just because there's an investment out there doesn't mean it belongs in your portfolio. There's times you should have things included, and there's times you should avoid certain investments or sectors because there's better places for your money. Again, if you have a question about your portfolio, send those to Brian Rezny at ReznyWealth.com. And as always, make sure you visit ReznyWealth.com. Click on our consultation tab. We do manage larger portfolios. Don't settle anymore. Look out for yourself. If you're realizing your results have been mediocre at best, the customer service, the communication is lousy with your current firm, only you can stop that negative effect. Call our office. There's a big difference in firms. Fee-only fiduciary money management is what we offer, and we're always looking out for our clients and their legal best interest. Brian, what are your thoughts on the offering of Newsmax, which is a media company? Is it something you would consider investing in? Longtime listener, great job, JB. JB, I would not buy Newsmax stock on an IPO. I don't think it's going to be a great growth proposition. While it's a media stock, I would tell you avoid most media stocks simply because most legacy media companies, and granted this is a newer one, but it's still in the same boat with all the other media companies, generally speaking. They're going to have low profitability, low growth potential. I would not invest in it. I think there's greener pastures other places. Brandon in Naples. Apple, AAPL, stock over the next few years. Brandon, fair disclosure, we actually own Apple at Rezny Wealth Management in some of our managed accounts, especially on the growth and aggressive growth side. Don't overload the boat. We like Apple. We think it's fairly valued, but we think the future, the next 3 or so years, looks promising. And the reason we say that, we think their earnings are going to grow above average. They've got a new replenish cycle with new phones coming out. I think a big driver on the Apple side ultimately is going to be AI, artificial intelligence, with more apps that will be driven off the newer phones, or you will need the newer phones for the power to run a lot of these apps. I think that's an opportunity for Apple. There's certain areas of the economy of investing that we truly like, and technology, generally speaking, looks most promising in the next 3 to 5 years. Liam in Punta Gorda, Florida. I'm considering investing in J&J stock after the recent earnings report. What do you think? We actually like J&J. We don't own it outright, but we own healthcare in general. I think one of the areas that we like over the next 3 or so years is healthcare, generally speaking. Valuations are fairly reasonable. Some are cheap. They usually have a good dividend stream. So as a total return objective, healthcare overall, we like, and we actually own that in managed accounts at Rezny Wealth Management. I'm going to take a quick break. Go to ReznyWealth.com. Make sure you download any of our groundbreaking reports. Our #1 downloaded report right now, the 3 biggest risks you must avoid for 2025. If you have at least a $500,000 portfolio, if you want to understand and avoid the mistakes that plague a lot of retirees and pre-retirees, go to ReznyWealth.com. I'll be right back with more after this. I've just released a groundbreaking report, the 3 biggest risks you must avoid now. If you're a retiree, pre-retiree, have at least a $500,000, this is a must-read report. I've covered the risks to your financial security and the facts you need to know to protect your hard-earned retirement savings. If you're at all questioning the advice you're receiving or your portfolio is lacking returns, go to ReznyWealth.com and download your free copy. I hope you're enjoying today's program. And as always, send your questions to Brian Rezny at ReznyWealth.com. And make sure you do visit ReznyWealth.com. I know we're getting a lot of questions that are coming in. I know a lot of you are probably visiting our website, and you're probably downloading our reports. One of the things I want to stress is 2025 is around the corner. What is 2025 going to look like for your portfolio? Are you going to settle for the same mediocre advice? Are you going to settle for the same conflicts of interest that maybe are currently plaguing your portfolio? Or are you going to look out for yourself and call Rezny Wealth Management? Remember, we are a fee-only fiduciary money manager. We actually manage money in-house. We don't sell other people's services. We don't sell annuities or commission products. We are truly fee-only. We truly manage money. We're an actual money manager, which is exactly what you need. Let me talk a little bit about your retirement security and what you need to be doing today and make these necessary changes. I think a lot of investors today, unfortunately, when they look at retirement, they don't do a retirement plan is number one. Number two, a lot of retirees, either pre-retirees or retirees, tend to be too conservative with their portfolio. And it actually may not be your fault. It could be the fault of the current advisor you're using or the brokerage firm you're currently utilizing. Most of these firms, I find, actually do not listen to the client. They actually do what's called age-based asset allocation. They'll say, hey, you're 70 years old. You should have 30% of your money in bonds and 70% in equities, or 70% in bonds and 30% in equities. They kind of go with that mantra. The problem is it doesn't align with your ultimate goals and objectives. So actually what you need to do is look at what is your risk profile. Age has nothing to do with it. It's really your upstairs and your emotional attitude towards your money having volatility. And should you be invested differently based upon where the economy is headed, not where the economy's been. One of the detriments to many retirees over the last 3 or 4 years has been owning too many bonds in your portfolio and owning the wrong maturity bonds in your portfolio. Bonds in general, for a lot of investors that we've seen in the last 3 to 4 years, have done horrifically poor because as the Fed raised rates, your bond value sunk and dropped a lot. So now you may be wanting to make bond exposure differences or changes now, and they may be appropriate for your retirement security. One of the other things you need to do is you need to reduce investment stress. Every investor, there's not one out there that has some form of investment stress. The key is what really causes that investment stress. It's often poor communication from your current advisor, not understanding that your portfolio is properly diversified and that you are actually looking at the next 3 to 5 years in the proper light and investing your money so that it can weather storms of not only inflation, but also the necessary needs you need for your retirement income to grow for the future. Investment stress, again, comes in multiple forms. And you as an investor need to understand sometimes, again, it could be from the lack of information you're currently getting from your current advisor and not communicating properly how you're positioned. Market corrections are another big one that often plague investors. We try to explain to every investor, stay calm and avoid the panic. Remember this, your portfolio never goes up in a straight line. Think about your portfolio going up 3, 4, 5 steps and then coming down a step or two. That's a normal correction. Corrections happen every single year, not only in the stock market, but the bond market, real estate, gold, all investments have corrective phases throughout every calendar year. But unfortunately, equities are often painted with equities are risky. No, equities are not risky. They're no more risky, in our opinion, than the bond market is. Remember, if you look at the last 4 years of return on the bond market, it's horrific for most of you investors who own the wrong kind of bonds. If you were invested in the equity market the last 4 years, you're probably a pretty happy camper if you were positioned correctly. Oliver from Naples, trimming a bond that has performed well. Don't you rid individual bonds you bought at the cheapest price first in, first out. These give you the best yield. Excellent question, Oliver. So generally speaking, when you buy bonds, a lot of people buy bonds for the wrong reason. You don't buy bonds just for income. You can actually buy a bond for what's called total return. Total return is the gain of the value of the bond. Yes, bonds can go up in value. When interest rates go down, bond values rise. So you can actually buy a bond depending where the interest rate cycles are, and you can look for capital appreciation on your bond in addition to the interest. So what you want to do, Oliver, is this. If you buy bonds, try and buy them when yields are anticipated to start coming down, like the Fed is doing currently. So you want to be on more intermediate to longer dated bonds at that point. When interest rates do come down, there will be a point you may want to sell those bonds before maturity. Because if you bought a bond, let's just say at 4%, and the Fed basically starts reducing rate, your bond value actually goes up. So you might have paid $100 for that bond, and now that bond, let's say, is trading at $106. So then you calculate the yield to maturity, Your yield to maturity at this new value might only be, let's say, 1.5%. So you have to ask yourself, am I better to sell this bond at a capital appreciation now? Yes. Move the greener pastures and put that money somewhere else that would be a better opportunity for your money. So bonds are not meant to be buy and hold. They're meant to be bought, sold when appropriate. Ted in Naples. Palantir Technologies, PLTR, should I maintain my current position or considering selling shares? Ted, I don't know how much of Palantir you actually own of your portfolio. We actually like the company, but I will say this. It is extremely highly valued, if not overvalued. It's trading about 150-55 PE ratio to next year's numbers. That's pretty crazy, considering the S&P trades about 18 times. So what I would say to you is this. If you own the stock, never buy more or own more than 5% of any one individual stock. Never more than 5. If you own 5% of that stock or more, I would trim it down immediately down to 3%. When stocks get that greatly overvalued, trim them down to 3% max, let it ride back up. If it rides back down, you've already trimmed a lot of exposure and you've taken profits. But if it does continue on its path upward, you still own 3% that could go up quite a bit. Diversification is key with individual stocks. You cannot overload the boat no matter how well the stock does. Trim exposure, best thing you can do. John in Naples, Walt Disney Company, DIS. I own Disney. My advisor says I should hold it, but he is also the one who recommended it 5 years ago and was wrong. I want your thoughts. John, that's an excellent question. So bottom line is I do not like Disney. It's going to have very low and slow earnings growth going forward. I would sell Disney, take your loss. Disney has done horrible the last decade, but people buy Disney because it's Disney. You need to buy a stock that has earnings growth. If a stock does not have earnings growth, meaning the earnings are growing, at a decent clip. Usually 8 to 10% earnings growth would be acceptable or better. If a company is not growing earnings at a decent clip, chances are either the earnings are stagnant or they're going down. If those are the two scenarios, usually that stock languishes or it drops a lot like Disney. So it's a stock that's not going to have good future growth. It's already down. You probably have lost quite a bit of money on it. Take the tax loss, move on to greener pastures. Best thing you can do is know when to sell and know when to buy. You bought wrong. You got bad advice from your advisor. You probably want to call my firm because clearly your advisor is not a money manager and they're not fee only because they're making recommendations, not actually managing money on a discretionary basis. Go to ReznyWealth.com. Go to ReznyWealth.com and make sure you download our groundbreaking reports, the 3 biggest risks you must avoid for 2025. If you care about your retirement savings, and you want to avoid the pitfalls that often plague many retirees and pre-retires, you can also click on that consultation tab. I'm going to take a quick break as always. Send those email questions to Brian Rezny at ReznyWealth.com. I've just released a groundbreaking report, the 3 biggest risks you must avoid now. If you're a retiree, pre-retiree, have at least $500,000, this is a must-read report. I've covered the risks to your financial security and the facts you need to know to protect your hard-earned retirement savings. If you're at all questioning the advice you're receiving or your portfolio is lacking returns, go to ReznyWealth.com and download your free copy. I hope you're enjoying today's program. A lot of questions are coming in. Go to ReznyWealth.com. Download the 3 biggest risks you must avoid for 2025 report. It is free, it's instant download, and it's only available at ReznyWealth.com. Let's talk a little bit about reviewing your assets and what you should be upgrading. One of the questions I often get from my TV and radio show listeners is, Brian, I own investments in my portfolio. Let's say you own 10 as an example. How do I know how to upgrade investments? So this is how we work at Rezny Wealth Management. When we build a client portfolio, there's a lot of research that goes on not only before we invest, but of course after we own investment assets. It's a daily research on every one of those investments. What we're doing is when we buy an investment, we buy that investment because we feel that is best given the current structure of that investment, the current economy, and the direction of that industry or that particular investment. When do we upgrade? When there's better places for that money. So when we manage money, we look at the investments we own every day. We're always looking at new opportunities out in the horizon, and if something starts to come over the horizon that looks promising and a better opportunity, we want to basically sell our weakest investments that have our least conviction and upgrade parts of that portfolio over time. Sometimes we make adjustments 2, 3, 4 times a year to client portfolios. Sometimes it could be more, sometimes it could be less. It depends on the changing dynamics and when we need to upgrade. One of the keys I want you to focus on for 2025, focus on high quality investments with strong fundamental growth. I talked earlier, earnings growth drives stock price. If a company has flat earnings, chances are the stock is flat or going down. If earnings are going down, that stock price is probably going down quite a bit. If earnings are growing above average, above the average of the S&P, let's say that might be growing earnings at 6 to 8%, you have a chance that that stock might outperform the overall S&P 500. Not a guarantee, but that is a major driving factor, is fundamental growth on earnings. If you don't have earnings growth, again, those are usually lousy performers overall. The other big thing you need to consider is selectively adding the positions at discounts. You might buy an investment, you've done a lot of research, and temporarily that stock or that investment comes down a little bit. No stock goes straight up. We've bought many investments over time, whether it's an ETF or a stock, that the day we buy it, all of a sudden it goes down 4 or 5% for really no reason. What do? Hey, the reasons we bought it make total sense. We're going to add to that position and bring it back up to the value that percentage value we believe it should be in a client portfolio. Don't be afraid to add to positions that have temporarily come down, as long as the fundamental reason has not changed and it still looks positive for the future. Mike in Cape Coral, Florida. I know you handle larger clients, but I can't find a fee-only money manager after interviewing 5. They all are fee-based. Have all conflicts that you warn about. Do you make exceptions? I need help. Mike, that's a great question. You know, I will say this. Every single year, we have literally hundreds of phone calls into our offices, people just like you who are looking to hire Rezny Wealth Management. Yes, we do make exceptions off our $1 million. Occasionally, I would say if you're a nice person to do business with and you're non-emotional, give the office a call. We can at least talk to you and see if we can make a possible exception. The one thing that I do want to stress is you only want to hire a fee-only firm that actually manages money in-house. Unfortunately, again, this is an article by the Wall Street Journal. 2% of firms, based upon that article, are fee-only fiduciary. And again, from our experience managing money 35 years, what we find, maybe 1 out of 100 people that come into our offices to interview us and then ultimately hire us, maybe 1 of those out of 100 are actually currently working with a fee-only firm. But almost all of the people say, I thought the firm I was using was actually fee-only when they were really fee-based, and they were still had all the major conflicts that the banks, Wall Street firms, and insurance companies have. You really need to make sure you ask the questions, and you really need to get it in writing. One of the great tools we provide you for free, go to ReznyWealth.com, click on the Special Reports tab, download for free Real Advisor, Fake Advisor. It's the questionnaire you need to give you the ammunition, the power to ask the right questions to make sure that firm you're ultimately interviewing and you ultimately entrust your money to is fee-only fiduciary and a money management firm. Lucas in Fort Myers. I have a portfolio with a large firm, a 60-40 stock to bond split, but they have me in 40% U.S. stocks and 20% emerging market stocks for equity portion. Any comments on this strategy? So again, the 60-40 portfolio, this is pretty much what is pushed by most of these firms. Unfortunately, I don't believe in that strategy. There's times you don't want to own 40% bonds. There's times you don't want to own any bonds. Maybe you want to own more cash. The problem that I find, and I see this often, is most of these firms push the 60-40. You always have to have a helping of bonds in your portfolio. No, you do not. Now, as the emerging market exposure, I don't agree with that at all. If you look at the emerging markets and how well they've done the last 5, 10, 15, 20 years, they've done horrifically poor. Way more volatility than the U.S. marketplace. They've greatly underperformed the U.S. marketplace. I think you need to find yourself and interview another couple real money management firms. I would suggest you call our office if you've got a larger portfolio. But owning that much emerging markets makes 0 sense. More risk, more volatility, and it's been just an outright lousy performer for decades. Steve in Cape Coral, Florida. My advisor recently discussed long-term care insurance. He wants us to invest $200K in a policy that gives us disability coverage, but it also is an investment. You always warn against insurance products, your thought. First off, your advisor is not a fee-only fiduciary money manager. That I can assure you. Number two, you never mix your investments with any insurance. That is ridiculous. I will tell you, if you buy that $200K investment to buy long-term care insurance, you are making one of the biggest financial mistakes of your life. You are buying a highly expensive long-term care product with lousy investment options internally that's ultimately going to rob your net return. Invest your money wisely. I would recommend you do not buy long-term care. The policies for long-term care have gotten progressively worse over the decades. Years ago, they weren't bad. Still expensive, but they weren't as bad. What happened is all these insurance carriers got a shellacking where they had a few claims on these long-term care policies, didn't make the money they thought, and then either wanted to cancel the policies on you, the policyholder, or change the overall language and what your benefits were going to be. My opinion, if you don't have a lot of money, you don't need long-term care because the state's going to pay for you anyway. The chance of you going into an ultimate nursing home is slim to none. If you have $1 million or $2 million, you can afford to go into a nursing home and pay your own cost for the 3 or 6 months you may be in there, but probably will not. Ethan in Florida. I'm trying to find out if Vanguard is a fee-only fiduciary. It's all confusing. Ethan, I would suggest you go to Vanguard's site, scroll to the bottom, read their ADV, all their disclosures, and their CRS form. So in short, Vanguard is a brokerage firm that creates investment products. They do have some fee-based work they do, so they're fee-based, but they manufacture products. So again, they get other revenues from other sources of those products. Not necessarily commission, but other fees from those products. So they would not be considered fee only. And again, their own disclosures you can read on their website would basically indicate that. Again, 2% of firms, based upon an article from the Wall Street Journal, are truly fee-only fiduciary money management firms, and you need to understand the difference between fee-based, fee-only, which is substantially different, and it's much different than pure commission firms. You as an investor are the only one that can protect your money from all the conflicts out there with firms that have various conflicts and or sell products and or manufacture, and only you can decide to protect your money from that. I'm suggesting go to ReznyWealth.com, click on the special reports tab, download for free. Real advisor, fake advisor, educate yourself. Folks, I'm just about out of time, and as always, go to ReznyWealth.com, click on that consultation tab. Only you can decide the advice you're ultimately going to receive. Only hire a fee-only fiduciary money manager. We'd love to earn your business. We've been doing this for a long time, and as always, competence is vitally important when you hire a firm, and you need to make sure the firm that you entrust your money is doing the right job for you. We'll see you next week.